In this video, we are going to do an overview of options and a little bit on how they are part of the corporate finance realm. So options, an option gives the holder the right, but not the obligation. And that's the important part, not the obligation to buy or sell a given quantity of an asset on or before a given date at prices agreed upon today. The quick, simple example is I can enter into an agreement or contract with another person saying, here is a premium, here's a little bit of money for you to give me the option, the opportunity, but not the obligation, to buy certain amount of shares from you at this price. Regardless of what the price in the market is, you agree to sell it to me and I'll buy it from you for a specific price that we agreed today. Now, I will have, let's say, a 3-month window. The time varies for me to decide if I want to buy it or not. If I choose to buy it, regardless of the price on the market, you will sell it to me for that price. Or I just say, like, you know what, I don't want to buy it. Keep the money I gave you, the premium, that fee that I gave you for having that possibility of buying it at a certain price. Now, the other party is obligated to sell it to me if I choose to buy it. That's why they collected that fee. So exercising the option, the act of buying or selling the underlying asset, that's when if I decide to say, okay, I will buy it for that price, then I'm exercising the option. Other terms are strike price or exercise price. That is that price in which we agreed on. That's the price I'll buy it from you. That's the price you'll sell it to me, regardless of what price is on the market. Expiration date, let's say the 3 months go by, in our example, and I decided not to buy it, then it expires. And the other person keeps the fee and doesn't have to sell it to me after that. If I want to still have that option, I'll have to buy another one again for a fee. And that example that we just talked about, that's what's called a call option. So there are 2 flavors of options out there, European and American options. European options can be exercised only at the expiry date. So if we agreed in 3 months from now, I would have to wait the 3 months before I tell the person, okay, I'll buy it. Now, that does not mean that I cannot sell the option contract. That's option trading, slightly different conversation, because the value of an option does go up and down as time goes by. A lot of factors impact it. We'll talk about that later. But I can sell the option to the person for that other person to have the right, but not the obligation to exercise at expiration date. That's European. The American option can be exercised at any given time. So with American option, you have more flexibility. You can either buy or sell the option to another person, or you can go ahead and exercise it at any given time. You do not have to wait at the end of the 3 months. You can do it a week in, 2 weeks in, 3 months in. Exercising the option would result in a positive payoff. I'm going to change the way they're rephrasing that, because it doesn't mean that every time you exercise an option, you're going to make money. No, what they're saying is that the only time people exercise the option is when there's a positive payoff. For example, if I agreed, or the option I purchased and the person agreed to sell me the stock, or let's say $50, and on the market, the stock is up to $55, then yes, I will exercise the option. So I can buy it for 50 and sell it for 55. But the reason that I made money is because there was already money to be made. There was a positive payoff, not because I exercised it. So the way that sentence structure sounds like if you exercise it, you make money. No, If there's an opportunity to make money, then you exercise it. So that is what in the money means. At the money, exercising the option will result in a zero payoff, meaning that it's a break-even point. At that point, whether you exercise or not, you end up with the same result. Most people don't exercise it at the money. They just let it ride, let it go, because what's the point? Out of the money, that is when the prices and the stock in the market is not in your favor. And if you, for some reason, exercise it, you will lose money. But no, you wouldn't exercise it. You would just let it go. Now, these definitions that you see here, in the money, at the money, and out of the money, they do not take in consideration the fee the person pays to purchase the option contract. This is just strictly talking about the exercise price versus the price on the market. However, once you factor in that fee that you paid, you'll have to overcome the fee before you actually start making money. We'll talk more about that in a few moments. So more on call options. Call options give the holder the right, but not the obligation, to buy a given quantity of some asset on or before sometime in the future. Pretty much the example I already spoke about. The reason buy is in bold, because later we'll talk about the put option, which is the flip side, where you sell it instead of buying it. Here's a graph showing what they talk about when are you in the money or out of the money, etc. This one is not taking into account the premium, that fee that I spoke about. So this is without fee. What happens is they have a situation where the excise price is $50. So as we mentioned before, and there's a call option and you're on the buy side, if this stock price in the market is less than $50, you would not exercise it because you would lose money. So there's zero profit. That's why there's zero there. That's where you would be. But as soon, and remember this, without any fees included, as soon as it goes above $50, then you start making money. You would exercise the option and you'll make the difference between the 50 and the actual market price. Now, regarding profits, here's an example where you have to overcome the premium. Premiums vary. It depends on the type of security and the length of the option, etc. But on this example, this premium is $10. So you go ahead and pay $10 to have the right to this option. If it doesn't work out and you don't exercise it, you let it go, the $10 are gone. So that's why they show you here that now you have to reach $60 to overcome the premium and then start making money. Okay, so here the premium was not included. So anything above $50, you start making money. And if you don't, there's no loss because there was no premium. But the reality is that there is premiums, and now you have to overcome the premium. So anything below 50, you wouldn't exercise for sure, because it just increases your loss beyond the $10. So that will be the maximum loss you'll have, will be the premium. Between 50 and 60, it is below zero, but you would want to exercise it. And the reason is because at least you recover some of your $10. Let's say it's about to expire and there's no signs that it's going to go above 60. Then in the last minute, you can go ahead and exercise it anyways. So at least you recover some of the $10. So notice your loss starts going down. The line is going up. The line is going up, but that's because but what it's doing is reducing your losses. So your loss becomes less and less of the $10 until you hit the $60 mark, where you at least would recover your $10. Anything above 60, you have recovered the $10 plus you're making money above it. So technically speaking, anything above 50, you still want to exercise, but one is for minimizing losses. And then beyond this point will actually be profitable. Put options. This would be similar to short selling stock, or at least the same concept applies. You make money when you buy a put option, you make money if the stock price goes down. So by definition, put options gives the holder the right, but not the obligation, to sell a given quantity of an asset on or before some time in the future at prices agreed upon today. When exercising a put, you put the asset to someone. Yes, those are the words and the terms they came out with. So when you buy a put option, you are agreeing, or let me put it this way, somebody agreeing to buy it from you at a specific price. You're not buying it now, you're selling to that person, but they're the ones obligated. You buying the put option. They wrote the option, and what they're saying is, if you give me the fee, I agree to buy the stock from you at a certain price. So if you think the stock price is going to go down, this is how you make money. Let's say you get in a put option, the other party agrees to buy it from you at $50. So the stock price goes down to 45. You would exercise because that person will buy it from you at $50. So what you do, you exercise it. So now you buy the stock at 45 and they agree to pay 50 for it. So you make the difference. So now you're kind of like on the other side, but you are still paying the fee. So you have the option to do this or not. You're not obligated to do it, but they're obligated to buy it from you at that price. So the chart will look differently. This is the example where if the stock price and the market is above $50 and that other party agreed to buy it from your 50, you don't want to exercise it because you will have to buy it for $60, $80, or $100 and then sell it to them for 50. You will lose money. But since you're the one that paid the fee, you're not obligated to sell it to them at 50, but they're obligated to buy it from you at 50 if you exercise. So what happens is, my example that I mentioned earlier, if it drops to 45, let's say you start making money. And as the stock price drops, you can make more and more money. Theoretically, if the stock price drops to 0, you'll make the entire $50. Now, notice a key difference here between this and this. When you buy a call option, this line could go up to infinity, theoretically speaking. So your losses are minimized, but that line can go up to infinity. Same here. Your losses will be capped at $10. That's the most you will lose, the premium, but the stock price could go up to infinity. So theoretically, you can make money infinite amount. Now, the thing with a put option is your profit has a maximum. So it's the flip side. Your profit has a maximum of whatever that strike price was. So the most money you can make if it goes to 0, in this case, after the premium of $10 is $40. So the maximum profit is a strike price minus the premium that you paid. So there's a maximum profit. Here, there was an infinite profit and a minimum loss or maximum loss. Here it flips. There's a maximum profit, but the loss could be infinite depending. But because you don't have to exercise, your loss will still be just the premium. So that's a big difference. Here, yes, your losses are the premium, but your profit has a limit. Here, your losses are still just the premium, but your profits are unlimited. However, in a bear market, this will be the way to make money, because this will not be really an option or an opportunity, because at a bear market, prices are going down. So now if you are the one selling the option or the writer, so same things that we spoke about, but you're on the other side now. You're the one selling the contract and collecting the fee. So all that does is pretty much flips your situation. If you are buying the call option, when you buy it and you pay the fee, you make money, the stock price goes up. But If you are the person that sold the call option and you collected the fee, you're better off if the price does not go up, because then it won't be exercised. And the flip side here, if you're the one that sells the put option, you collect the fee, you're better off if the stock price goes up. Now, combination of options. So what happens is you can go ahead and do combinations of different options with different prices and different strike prices. I should say different strike prices and different premiums and fees, and do some improve your profitability by doing combinations. Puts and calls can serve as the building blocks for more complex option contracts. If you understand this, you become a financial engineer, tailoring the risk return profile to meet your client's needs. Now, two things: you can do trading strategies and options by combining them, but from the corporate side perspective, options are a great tool to hedge the positions of a company on their projects and things like that. For example, always the famous it was done with an option, it was done with a future contract, but Southwest Airlines used this type of contract, a derivative is what we call it, in order to hedge changes in fuel prices. So you can do that same with options. You can lower your risk of your company through hedges with options and combinations of options. Then we have valuing options. As I mentioned earlier, you can trade options. You can go ahead and get into an option, and before it expires and you have not exercised it yet, you can just sell the option to another person. And the reason is because the option has other elements that add value to it. So sometimes selling the option is more profitable than exercising the option. There's a lot of other factors that come into play there. That's more for another class, a derivatives class, more advanced class in securities. But understand that if I go ahead and buy an option, it could be in the money, but because there's other things that add value to the options and standard deviation and time left on the option, etc., the selling the option may bring me more money than exercising the option, as we explained before. So valuing them, it's a different way a different calculation, a different way to value than you would like with stocks, for example. Now, these are the things that can bring the value up or down of an option. It does it at different degrees, but these are it. So if you're buying, these are based on if you are the buyer of the option, not the seller, as I spoke earlier. So if you're buying a call option and the stock price goes up, the call option goes up, the value, because that one makes money when the price goes up. But if you buy a put option, you were in a position that you want the stock price to go down. So the stock price goes up, the value of the put option is going to go down. Exercise price. The higher the exercise price, the lower the value of the call option, because it's harder to reach that target, to pass it. And opposite is true, because you want the stock price to go down in this case. Interest rates, if they go up, the call options go up, the puts go down, the value. Volatility in the stock price. In both situations, if volatility goes up, the value of the option goes up. The simplest explanation for that is because it increases the probability of hitting the exercise price or passing it. The more volatile it is, there's a higher chance of the option to go in the money. But because of the higher chance, then the value of the option goes up as volatility increases. Expiration date. The longer you have to wait for the stock price to move in your favor, then the higher the chances of you eventually hitting that mark. So similar to volatility, the more time you have, the more value there is in the option, because there's a higher chance of eventually hitting that target. And as time, time, you can't stop it or hold it. So time starts going by and reducing. So as times go by, that affects the value, starts decreasing the value. Now, these don't work in isolation. What happens is that they're all changing, well, except the exercise price, They're all changing constantly except the exercise price. So as they all change, they're all going to change different rates. They all have different power and the impact on the value. So a lot of things come in play. So the calculations include all these elements in order to get a valuation. So sometimes they cancel each other out, or one is more overwhelming, etc. Now, there's a variety of ways to value an option. A popular one right now is the Black-Scholes model. The people that invented this formula, or derived this formula, I should say, won a Nobel Prize in economics for it. And it's the popular one out there. This formula here is just pretty much explaining the variables and how to calculate it. We will have a different video on an Excel sheet going through an example so we understand how the formula works. That will be it for this video. See you on the next one.